What if I told you the stock market doesn't always go up? Of course, everybody knows there are always going to be periods of time when the stock market goes down. And of course, if you hold long enough, those stocks are bound to recover. But that doesn't do you much good if you retired, let's say in 1929, because it took 26 years before the stock market finally got back up to its previous all-time high. It's very possible you might have already even died by then. And extended periods of time with subpar returns are not isolated to the Great Depression. Take the Japanese stock market, for example, which peaked in 1989 and still to this day has not recovered 34 years later. So it's actually not very helpful to just say, just hold on to your stocks and someday they'll recover. But is it even possible to know whether you are entering a period of time where there are going to be subpar returns for potentially decades to come? And more importantly, even if you do know that, how can you protect yourself? But first, a word from today's sponsor, Vaulted Silver. Did you know that most of the time silver is more expensive than gold? Obviously, I don't mean per ounce, but most of the time when you're buying silver, you're paying 20%, 30%, even up to 50% in premiums, markups, and commissions. But Vaulted Silver is changing the game. Vaulted Silver has managed to cut out 70% of the traditional supply chain for silver. This eliminates almost all premiums for buying physical silver, and it also increases security. With Vaulted Silver, investors always own designated serial numbered bars or specific sections of segregated bars. This is a different model than most services that offer pooled metal. Vaulted Silver investors can even move their holdings into smaller coins or bars at any time to take physical delivery. This groundbreaking pricing paired with their rock solid asset structure is something no competitor can touch. They were able to do this because of a unique partnership with HSBC Bank. HSBC Bank is one of the 4 large institutions that is the core of the London bullion market, which is the largest and most liquid in the world. And the only reason Vaulted Silver was even able to form this relationship is because of some other projects the company has going on. Because usually HSBC vaulting services are reserved for the massive players like GLD and even like central banks. Clearly, Vaulted Silver is being launched on the back of an enormous amount of time, effort, and money, all put into making the top of the line, world-class silver storage product for you. As always, the Vaulted website and app are insanely easy to use and allow you to get started in literally just a couple of minutes. And the best part is they gave me a discount link to offer you that actually gives you free storage on your silver through the end of this year. So if you want to take advantage of that crazy deal, sign up for Vaulted Silver using the link in the description today. First, let's take a look at something called breadth. Breadth with a D, not breath. Stock market breadth is at an extreme level right now. The total market cap of the S&P 500 is heavily weighted in the top 10 biggest stocks. 34% right now. That's 34% of the total size of the entire S&P 500 is made up of just 10 companies. But it's more than just the size. More importantly, it's about the performance. Right now, the performance of the S&P 500 is being driven by just 5 companies. That's right. 96% of the S&P 500's performance this year has come from just 5 companies. These 5 companies make up 2.9 trillion of the S&P 500's $3 trillion worth of gains. That means the other 495 companies together have contributed only $110 billion in gains collectively. But it gets even more extreme than that. If it weren't for just one company, NVIDIA, the S&P 500 would be negative this year. So why is this concerning? Well, specifically with NVIDIA, it's in a giant bubble right now. The PE ratio of NVIDIA right now is 204. That means if NVIDIA was going to take all of its profits, every cent it makes in profits, and pay it out to shareholders as a dividend, all of its profits, paid out in a dividend. It would take you 204 years before you got paid back for your entire investment. That's not a normal valuation, that's a bubble. Or at the very least, that's what they call overvalued. Okay, so we know there's at least a small issue. There's a large amount of money flowing into a small amount of stocks, driving the overall performance of the entire market. But to understand what we're supposed to do about it, we have to figure out what's causing that problem in the first place. In short, this problem is caused by passive investing. Passive investing is the trend where people throw money into the stock market and pay no attention to what they're buying or why they're buying it or what the value is of what they're buying. They throw money in and say buy regardless, and they call it investing. Passive investing currently controls an estimated 37% of the stock market. So why is this a problem? Well, it's because all investing operates off of some set of rules. An investor who uses technical analysis will be making their buying or selling decisions based off of charts, patterns, indicators, moving averages. A fundamental investor will buy or sell based off of cash flow, a company's profits, or management track record. A speculator will buy or sell based off of intuition, being a contrarian for contrarian's sake, or trying to profit off of imbalances that they discover in the market one way or another. The point is that all investors operate off of some set of rules, but passive investors operate off of a set of rules that say, basically, if I have money to invest, buy it all, and if I need money, sell it all. Passive investors pay absolutely zero attention to any value metrics whatsoever. If there's a bubble and money comes in, we add fuel to the fire of the bubble. If everything is crashing and everything is undervalued, but they need money, we're just gonna sell. And again, add fuel to the fire and make everything even more undervalued. No regard for either bubbles or bloodbaths. Simply put, passive investing really isn't investing, it's just buying. Now, as Michael Green has pointed out many times in many places, this works out great when money is coming in. On net, when funds are being added to the passive investing system, this works. In fact, this is what caused markets to bottom in March of 2020. The Federal Reserve lowered rates on March 12th. But as you can see, the markets did not actually bottom on March 12th. They moved significantly lower from there. It wasn't until March 23rd that stocks actually bottomed and started moving upwards from there. So what does this have to do with passive investing? Most money in passive investing vehicles is done through balanced funds. If you've got a 401k, when you started at your job and that 401k was activated for you and your employer started throwing money in there, it was by default being invested in something called a target date fund. It looks at your age and it says, by this date, you'll probably retire, and we're gonna give you a specific mix of stocks and bonds. So when the Federal Reserve lowered interest rates on March 12th of 2020, they increased the value of bonds. This meant for all the passive investors in the entire passive investing universe, the bond portion of their portfolio just become overweighted compared to the stock portion of their portfolio overnight. And on March 23rd, all those funds started rebalancing and purchasing enough stocks to balance out their portfolios yet again. No regard to profits, no regard to management, no regard to mass psychology, no regard to macro, and no regard to value whatsoever. Simply buy because money came in to buy. And all of these preset rules, they drive money into the largest companies by design. The S&P 500 is weighted by market cap. So as people go to work and contribute money to their retirement accounts, and as money flows from the government into university endowment funds in the form of student loans, and as active investors close up shop because they just can't compete with passive, more and more money is just buying the exact same stocks, just because money is coming in to buy. So could this trend ever reverse? Well, yes, absolutely. Absolutely. And it's not a question of if, it's really a question of when. Because at some point, those funds will start flowing out. And the main catalyst of this is going to be the age of the population. There's a very fine line, a delicate balance between all of the workers who are putting money in to the stock market and all the retirees that are taking money out of the stock market. And if that balance becomes imbalanced and it tips over to the side of retirees, they start withdrawing more on net from all their retirement accounts, all their pensions, redemptions, stocks getting sold faster than money is getting put in, then this whole thing unwinds and everything gets sold simply because there's money coming out, regardless of value, because nobody's paying attention to value anymore. Nobody's looking for companies that are undervalued and nobody's trying to sell companies that look overvalued. Just follow the crowd in and follow the crowd out. So what can be done? Well, simply don't be a passive investor. The same stocks that are getting all the good attention now are the ones that will get all the bad attention later on. It's always like this. All the darling stocks that were the tech companies and the future changers and the IPOs and the SPACs that happened during 2020 and 2021 were getting all the good attention then and are doing terrible right now. Look at Coinbase, which fell from a high of $428 per share down to its current price of $58 per share. Or Robinhood from a high of $84 per share down to its current price of $9 per share. Or Nikola from its high of $93 per share down to its current price of 55 cents per share. Or Block from its high of $289 down to its current share price of 63. You get the point. Investing isn't about blindly throwing money at a company or at an index. Either way, it's gambling. Truly, investing is about allocating your precious capital to a company that you have a high degree of confidence that it will return your capital to you with a decent profit at some point in the future. That requires you to look well into your investments, or at least partner with somebody else who does. And that is something that cannot be done passively by definition. Investing is an active activity. This is why some of the best investors of all time, like Warren Buffett, they don't do themselves what they're telling other people to do. Berkshire Hathaway has outperformed the S&P 500 by a massive margin because Warren Buffett invests actively, intentionally, and he takes care to buy things that are value. Now, just in case you think that this is an activity that is out of your league, don't worry, it is not. It's very easy to step away from the passive bubble. With any investing account that gives you access to passive funds, you also have access to active funds. Even if you don't have the time to commit to doing the research to picking stocks yourself, you can very easily pick an active fund that does that for you, that does pay attention to value, stays away from overvalued stocks, and tries to buy undervalued stocks. You can even learn basic hedging strategies so that you're protected in the event of a long-term stock market downturn, like has happened many times in the past throughout many countries. In summary, that old adage that stocks always go up in the long run is a misdirection at best, and at worst is intentionally deceptive. It does you no good if the stock market does finally recover someday if you're dead by then. So do yourself a favor. Don't blindly throw your money at some overvalued bubble just because the rest of humanity is chasing that bubble as well. Because when the tide turns, and it will, you'll likely get trampled trying to get out the same exit at the same time as everybody else. Learn some fundamental analysis, learn some technical analysis, learn some hedging techniques, or again, partner with somebody else who can. And finally, if you'd like to learn more about things like hedging and fundamental analysis and portfolio allocation, take a look at my Heresy Financial University membership program with an ever-growing library of training material linked in the description below. As always, thanks so much for watching. Have a great day.